When I started my journey in the financial markets, I was just like you. I came in with big expectations and an eagerness to learn. But what I didn't realize is that the biggest challenge wasn't understanding charts or numbers. The real challenge was understanding the mistakes the market would make us commit, especially when we're just starting out. Let me be clear. No one starts with all the knowledge. The truth is, the financial market is unforgiving, and it's naive to think you can be invincible right off the bat. But over time, I learned one valuable thing. What you learn from your most painful mistakes is what shapes a successful investor. And today, I want to share with you the lessons that helped me overcome the traps of the market. When most beginners enter the market, they're often driven by one thing: the idea of making quick profits. They dream of hitting it big without realizing that the market isn't a shortcut to riches. Instead, it's more like a maze, where every turn can lead to unexpected dangers. The real trap is the misconception that success comes easy. New investors often fall into the habit of chasing after the next hot stock, trying to replicate success stories they've heard about. But what they don't see is the years of experience, strategy, and yes, even failure behind those stories. The trap isn't just about picking the wrong stocks. It's about falling victim to the allure of instant gratification. If you're starting out, it's crucial to understand that the market rewards patience and discipline, not impulsive actions or short-term dreams. In the world of investing, the crowd is often wrong. The majority of people tend to follow the herd, believing that if everyone is doing something, it must be the right choice. This is where the power of contrarian thinking comes into play. Contrarian thinking isn't about being rebellious for the sake of it. It's about recognizing that the market is driven by human emotions, and emotions tend to exaggerate extremes. When everyone is buying, the market can be overvalued. And when everyone is selling, the market can be undervalued. By thinking differently, you can spot opportunities where others see none. I've seen it time and time again. Investors who make their fortune aren't those who follow the trends, but those who step away from the noise and think for themselves. It's about having the courage to make decisions that others might not understand at first. But here's the key. Contrarian thinking doesn't mean betting against the market at every turn. It means making informed, calculated decisions based on independent research, not just following what everyone else is doing. This approach can help you avoid the trap of thinking you're making the right moves just because it's the popular choice. One of the biggest mistakes beginners make is believing they can predict the market. This idea often comes from the allure of being able to time your investments perfectly, like hitting a home run every time. But the reality is, predicting the market is impossible. Even the most experienced investors, including myself, cannot accurately predict every twist and turn. The market is influenced by countless variables, economic data, geopolitical events, market sentiment, that are constantly changing. What worked yesterday may not work today. Trying to predict short-term market movements can lead to frustration and, worse, impulsive decisions. The key to success in the market isn't about predicting where it's going next, but about managing risk, making informed decisions, and staying patient over the long term. So instead of focusing on predicting the next big move, focus on understanding the market's behavior and adjust your strategy accordingly. The goal isn't to be right all the time. It's to manage risk and stay in the game. Leverage can be a powerful tool in the market, but it can also be incredibly dangerous, especially for beginners. The idea of borrowing money to amplify your potential gains might sound tempting. After all, The larger your position, the larger your potential return, right? But what many don't realize is that leverage works both ways. While your profits can increase exponentially, so can your losses. This creates a double-edged sword. A small move against you can wipe out your entire position. For someone just starting out, the risks of using excessive leverage can be catastrophic. It's easy to get caught up in the excitement of big gains, but leverage can magnify losses just as quickly. In fact, many of the most experienced traders avoid using leverage as much as possible because they know that the market can turn against you in the blink of an eye. The key takeaway here is simple. Don't let the allure of quick profits cloud your judgment. Instead of relying on borrowed money, focus on building your portfolio slowly and steadily, with a clear understanding of the risks involved. In the world of investing, patience and caution will always outweigh the thrill of instant success. One of the most underestimated factors in investing is the psychology behind it. The financial markets are driven by people, and people are inherently emotional. Fear and greed are powerful forces that influence every decision you make, whether you're aware of it or not. When things are going well, it's easy to feel invincible, chasing after every opportunity and letting emotions drive your decisions. But when the market turns against you, fear can quickly take over, leading to panic selling or poor decision-making. The key to overcoming this is to develop emotional discipline. Successful investors learn to control their emotions, separating their personal feelings from their investment decisions. It's about thinking logically and sticking to your plan, even when the market tests your patience. Remember, the market isn't just about numbers. It's about managing your mind and staying grounded in your strategy. The true challenge is not predicting the market, but maintaining emotional control through the ups and downs. Have you ever made a decision that you later regretted, driven by fear or excitement? In the world of investing, emotional decisions are often the ones that lead to the most significant losses. When you're starting out, it's easy to get caught up in the rush. You might feel a sense of urgency when you see others making big gains, or a fear of missing out when the market dips. But these emotional reactions are the perfect storm for bad decision-making. The key to avoiding this trap is creating a solid plan and sticking to it. If you let emotions dictate your actions, you'll end up chasing losses or buying into hype, both of which are dangerous behaviors. It's essential to stay patient and let your strategy guide you. Remember, investing is a marathon, not a sprint. Decisions made in haste can hurt you in the long run. Take a deep breath. Trust your research, and stay committed to your plan. When you're starting out, it's tempting to put all your money into one or two stocks that you believe will bring you massive returns. But this is where many beginners fall into the concentration trap. Concentration may seem like a quick way to big gains, but it's also a quick way to wipe out your capital. When you put all your eggs in one basket, you're taking on more risk than necessary. If one of those investments fails, it can leave you with significant losses. On the other hand, diversification spreads your risk across different assets, industries, and even countries. By diversifying, you're reducing the chances that a single poor decision will destroy your portfolio. It's about balancing risk and reward in a way that protects you from the inevitable ups and downs of the market. Instead of betting everything on a single stock, consider building a diverse portfolio that gives you exposure to various opportunities, each with its own risk and reward profile. Many beginners come into the market thinking that the key to success is picking the right stock at the right time. But they often overlook the most important factor: managing risk. No matter how much research you do or how confident you are in your investments, there will always be uncertainty. The market is unpredictable, and risk is an inherent part of investing. The real difference between successful and unsuccessful investors lies in how they manage that risk. Risk management isn't just about avoiding losses, it's about understanding your limits and protecting your capital. This means setting stop losses, not over-leveraging, and not putting too much of your portfolio into high-risk assets. A successful investor doesn't just focus on maximizing returns, they focus on minimizing potential losses. By controlling risk, you're positioning yourself to weather the inevitable storms and come out stronger in the end. Remember, it's not about avoiding risk, but managing it wisely. So, how can you avoid falling into the trap of the market when you're just starting out? The truth is, there's no single formula for success, but there are fundamental principles that can guide you on your journey, and they've been the foundation of my own success. First, educate yourself. Knowledge is the greatest weapon you can have. The more you understand the market, the less likely you are to fall for impulsive decisions or popular myths. Take the time to learn about different investment strategies, risk management techniques, and market psychology. Second, be patient. The market rewards those who can stay disciplined and focused over the long term. Stop chasing quick wins and start thinking about building wealth over time. Investing isn't a race, it's a marathon. Stay consistent and let compounding work for you. Third, control your emotions. Fear and greed are the two emotions that can destroy an investor's strategy. The best investors know how to manage their emotions and stick to their plan, even when the market gets volatile. Finally, remember that the market is full of opportunities, but also risks. Diversify your portfolio, manage your risk carefully, and never put all your eggs in one basket. Understand that losses are part of the process, but don't let them discourage you. Learn from them and keep moving forward. Avoiding the market trap isn't about being perfect. It's about being aware of the pitfalls and having the discipline to navigate them. As you start your journey, keep these principles in mind, and you'll be better equipped to handle whatever the market throws at you.